Welcome to another video from Creativo Solutions. You're currently watching the Accounting for Non-Accountants video series. I hope these videos are helping you. Please post comments and questions below. Tell me what you need help with and I'll create the video. Please subscribe to the channel and visit the website for more content and resources. In this video, we're going to be looking at the third adjustment. We've discussed how long the financial reporting year is. Remember, it is 12 months long, and transactions don't always relate to the financial year. So when processing adjustments, we're trying to make the financial statements more accurate because I'm looking at the last 12 months and I'm providing for anything that needs to be adjusted at year end. Knowing the accounting rules are so important because we're going to be using them when processing the adjustments correctly. In case you forgot the rules, they're here. Remember, the rules are so important because we're going to be either increasing or decreasing the different accounts in line with what they are in terms of the accounting elements. We know disclosure is specific to the 12 months and transactions can either relate to the period during the 12 months or a period before or after the year end. We are going to be covering the income received in advance adjustment. So remember, transactions are recorded when they arise. So if a transaction arises today, I'm going to have to record the transaction today, but I may or may not have to adjust this at a later stage because the accountants are going to be presenting the information for the last 12 months. The financial year is 12 months long. So in this particular example, let's imagine we're receiving income today, but it has not been earned yet. If I have a receipt today, will I record a transaction? The answer is yes. Transactions are recorded when they occur. So if I'm looking at that particular moment in time, which is during the financial year, a transaction will arise. And if the transaction arises, I'll record the transaction in the books of the entity. So we've received income today, but it relates to a longer period of time. So it extends further than the year end. If I'm looking at 3 months being the actual portion that belongs to the current financial year, which is the 12 months that I'm analyzing and reporting on, then those 3 months will be viewed as being inside the financial year, which is then viewed as income. Any income that's outside the financial year would be viewed as income received in advance. You've received it during the financial year, but it relates to the future. So the 9 months of income that I've received today during the financial year that I've recorded is only going to be earned in the future. So 9 months is outside the financial year, and therefore I cannot recognize it in the 12 months that I'm analyzing because the financial year is 12 months long. So it must only record transactions for those 12 months. 3 of the 12 months can be accurately recorded as income because I've recorded it during that period, and anything outside the 12 months must be viewed as income received in advance. And if you think about the definition, well, what am I actually doing? Well, I'm recognizing something today which will only be earned in the future. So if I don't earn that income in the future, I'm then going to have to record a outflow. It's going to give rise to a future outflow potentially if it isn't earned at a later stage. So therefore, when looking at the definition, the disclosure is important. Income received in advance is referred to as an income received for future periods that you haven't earned yet. So what is the effect on the accounting elements? Well, let's think about it. If I haven't earned it yet and I've received it though, I'm either going to have to refund, the customer, render the service, or give the product. So I'm creating a liability because I've received something today which isn't mine, but it relates to the future. The adjustment journal entry, you're going to debit income and you're going to credit the income received in advance. The most important thing is to understand why you're doing it, and that's where the rules come in. So if we know those 6 basic accounting elements and those are the rules that we can apply in any situation, we are then going to motivate why we're debiting and crediting each of these accounts. Well, let's talk about income. Is the income that we're currently recognizing too high or too low? Well, think back to the example. We had received income for an extended period of time. I received income during the financial year. Only 3 months was actually part of the financial year. 9 months was outside the financial year. But when receiving the income, I would have recorded it as an income, meaning the income was too high. It was overstated. I haven't earned it yet. So that's why I'm going to debit the income, because by debiting income, I'm reducing the income because I haven't earned all of it yet. It is overstated and therefore I have to reduce it. Why do I credit the income received in advance? Well, we know it's a liability. You're creating an obligation today because you're going to have to render the service in the future or provide the product in the future. You need to earn the income. And that takes us to the end of this video. Please subscribe to the channel, post a comment below, and hit the thumbs up button if you like the video, and I'll continue to make more to help you.